In corporate finance, non-cash charges often elicit a dismissive wave of the hand from investors. It's just an accounting entry, they might say, or it doesn't affect cash flow. However, Intel's recent announcement of $18.7 billion in restructuring and impairment charges tells a far more nuanced story about the company's future and intrinsic value. The sheer scale of these charges, $15.9 billion in impairment charges alongside $2.8 billion in restructuring expenses, represents more than just cleaning the corporate house. It's a stark admission that Intel's once envisioned future, particularly during the pandemic's peak, has materially changed. This recognition manifests most pointedly in the $3.1 billion of equipment write-downs related to the Intel 7 manufacturing node, where boxes of never unpacked equipment stand as silent testimonies to overly optimistic demand projections. This particular charge is telling about management's decision to include it in their non-GAAP results. In the carefully choreographed dance of corporate financial reporting, non-GAAP metrics typically exclude one-time charges, presenting what companies consider a clearer picture of their underlying business performance. By including this $3.1 billion charge in non-GAAP results, Intel's management declares, "This isn't just an accounting quirk, this reflects a fundamental shift in our business reality." The impact on Intel's reported numbers is substantial. Instead of the modest 2-cent per share loss analysts expected, the company reported a non-GAAP loss of 46 cents per share. Without this charge, earnings would have been positive at 17 cents per share, a striking illustration of how profoundly these write-downs affect the company's financial narrative. But the real story here isn't about accounting entries but future cash flows and value creation. When companies record impairment charges, they acknowledge that assets will generate substantially less cash than expected. In Intel's case, the message is clear. A significant portion of its manufacturing infrastructure will not generate the returns once anticipated. This isn't merely a balance sheet adjustment, it's a reset of future expectations. The timing of these charges is particularly significant as Intel battles to regain its competitive edge. The company is launching crucial new products, including the Lunar Lake chip for AI PCs and the Granite Rapids server chip. Against this backdrop, the impairment charges might be viewed as Intel clearing the decks for a new chapter, a perspective seemingly shared by investors, who drove the stock up 10% in after-hours trading despite the massive write-downs. This relatively positive market reaction suggests investors view these charges as necessary in Intel's broader strategic repositioning. The $2.8 billion in restructuring charges, tied to a program targeting $10 billion in annual cost savings, indicates management's commitment to fundamental operational changes. Yet the Goodwill write-downs also hint at a sobering recognition that some of Intel's past strategic investments may never deliver their expected value. For those focused on valuation, these impairment charges demand a comprehensive reassessment of Intel's intrinsic value. They signal reduced expectations for asset productivity, raise questions about capital allocation efficiency, and suggest a meaningful reset in growth projections. The write-offs acknowledge that significant capital investments will generate lower returns than expected, affecting future free cash flow projections. This recalibration of expectations extends beyond immediate financial metrics. It speaks to Intel's broader challenge of maintaining its historical position in an increasingly competitive semiconductor landscape. The company's acknowledgement of over-optimistic pandemic-era projections raises essential questions about its ability to forecast and adapt to rapid market changes. Yet amidst these significant write-downs, Intel's core business shows signs of resilience. Revenue of $13.3 billion, while down 6%, still exceeded market expectations. This suggests that while Intel writes down parts of its past, its fundamental business retains value and potential. Ultimately, Intel's massive impairment charges represent more than an accounting exercise. They formally recognize changed realities and future expectations. Investors and analysts must reevaluate Intel's future cash flow potential and competitive position. While the market's initial reaction suggests optimism about this strategic reset, the true test will lie in Intel's ability to transform these acknowledged challenges into future opportunities for value creation.